We are with Gary's Tuesday report, back from a little bit of a break, and we're looking at the markets at key and critical levels. While we have had extended markets, we are getting quite concerned. There's that rotation happening within the sectors. The small caps are emerging. The indices are at key critical levels, and we want to understand that. As well, we're going to have a look at the standard ones, which are the Gary's opportunities he's identified in the ASX for his portfolio this week. So with that, we say welcome back, Gary Glover from Novus Capital. Good morning, Gary. How are you?
Yeah, I'm good, Chris. Yeah, it's funny. I didn't just take a week off there. Sort of, you watch it so closely. A week doesn't seem like a long time, but you feel far away from the market coming back. But it was interesting on the weekend. They're just scanning through stocks. Yeah, I just could not see too many good new opportunities there. Saw a lot of extended stocks. Saw a lot of exhaustive sort of type moves. Saw a lot of small caps really firing up as well, which is kind of what we would normally see in the later stages of bull markets. So just felt like you had a lot of those kind of end of move type characteristics sort of flashing as well. So just yeah, and then sort of that led me to sort of do a bit more digging and looking at some of these ranges and stuff where we've gone to, and then look in the past as well. And it's just unusual that when you have that sort of pullback, like we had in April, and then expand higher, like a lot of those moves have sort of only got, sometimes they've only go to like the 138 or maybe 150 or something like that. And those have ended moves typically, as in ended trends as well. So, yeah, it's just where we should have a breather really in that August to September. So if you don't get that, which is a pretty dominant pattern for these post-election years and also fifth years, then you can get what they call like an inversion, Chris, as well. So the cycle can invert. So instead of being like that October being a low, that could be the high. So it's just sort of something to be wary of there. We just got a couple of critical dates here coming up in the next couple of weeks. So we obviously got the Fed here Wednesday night, so Thursday morning our time. That'll be interesting there. So obviously we're going to get a rate cut of some degree. But yeah, we're just coming to some sort of key timings there that then normally would have seen a little bit of weakness there, but we've just seen sort of strength there. So that chart in front of me does worry me quite a bit on the NASDAQ, because that 2022-23 pullback, that range has now squared out to be almost 100%. So I think 22,333 would be 100% squaring that range. And so in the past, like the S&P, if you look at the 07, 09 range, every time that squared 100, 203, that has stopped the trend for at least 6 months. So it's been a bit of a marker there. Sometimes they can go to the 150 to 160 at 118. So we saw there the NASDAQ went to the 161.8, had a reaction back to back below the 100%. The S&P basically squared out to I think it went to the sort of, it squared 100%. That's when we got the reaction right back to the 100% move. So these are big levels there. So that NASDAQ is really close. So it's within I think we're within 1% or something of that level there. So just, that's a big level to keep an eye on there. So it's just normally sort of in a level where it stopped the market. And it doesn't say it's the all-time high, but it's often getting a high for the next 6 months, or it's marked a pause in the trend. So most of those squarings that we looked at prior to all the squarings from 07, 09, that air phase, all those 100% squarings were kept the market at bay for at least 6 months. So yeah, that's something to be mindful of. So that's, we're pretty extended here. We had a pretty good run. Everyone's, but yeah, it's I'm just a little cautious there. I know we've sort of got AI, which is revolutioning, so that's sort of can drive markets like 2000 there with the the internet kind of revolution. And then we've got interest rate cuts about to come, so they're normally seen as positive, even though this one's been pretty well forecast. But yeah, it'll just be interesting to sort of see what's happening here. But yeah, I'm just a little cautious there for once we get to that that level there. I think.
Well, let me just, because this took me a few years to really get my head around. We've been talking about these reports for the best part of a decade. So for those who are new, I wanted to just touch on these levels that you've got squaring out, because I know it all makes sense to me now, but it did take me a while to get there. So I'll just correct me if I've got something off here, Gary, but we're talking about the 22 to 23 range. So I'll use the charts on the screen here. We've got the high that we had late 21, which is showing the green dot on screen now. That's the high. Then it comes down to the low, which is the October low in 22. That range, if we mark it, is 100% from the high, 0% to the low. If we count that in points or just measure it on the chart, it's this vertical green line that we've calculated.
Yeah.
Now, so that's right so far for the range. It took a while for it to get back up to those highs that we had in 21, which was the first part of 2024. Is that right so far, Gary?
That's right. Yeah. So you're looking for levels of of that range as levels of possible resistance that we might face there. So oftentimes, and probably the big ones are the 150s, maybe the 161, and then the 200. So
well, let me draw those on. So if that's 100% of the range here, this green line, if we can imagine we copy pasted it and put it on top here, it goes up to where the 200% mark is. But as you've pointed out, the key resistance levels can be these other numbers here, which are fraction of this whole range, but from the breakout point, and they have been exactly that. They've been resistance levels.
Yeah. And if you want to do a good exercise of that, Chris, go and look at the 2007, 2009, which is the GFC. That's one of the biggest bear reactions we've had in the market for, say, the last 20, 30 years. So go, look at the S&P 500, square that pullback, and then square those ranges out, 100, 2, 3, 50s between, 400 or 500 levels. Go back and square that range, and you'll see all the main highs will be hitting the hundreds to two, maybe 250s, 3, 500%. Just those ranges there. And it's probably just the market's got to move in certain multiples. I guess it's like human nature there. You get 2 for 1, 50% off. Those are reactions that sort of move us to spend more and do more. So they're just normal fractals and stuff at the moment there. So,
well, you mentioned fractals. I actually want to just jump on this last one here of the range. We've used this range from 21 to 22, 23, and we've highlighted that in green. If I just go from a fractal perspective and let's make it blue. Here's the high that we had at the end of 24. And then we had that massive drop where we came into April 25. Those who've been with us for a year or so will remember that. If that's the whole range, that actually the high coincided with the 161.8 of this green range, but it created this new range, which is the blue one. And what you're saying is the fractal component here, sort of like a circle within a circle, a range within a range.
Yeah.
If we go 100% of it, well, the first marker is 33%, so this area, and 38.
Yeah.
That's kind of where we are now, which is what you're saying is resistance. Coincidentally, that is a confluence of this 200% range of the old green line. It's in the same space. It's the same area. And that's what you're saying. They're all sort of coming together. They're squaring out together. Is that what that's the mean by squaring out together, right?
So we got exactly right. So you got 200, which is a big one. And then you've got the 138 off that last range, which doesn't sort of sound that big. But if you go back and look at if you go back and look at the 60-year cycle, that pullback there, so that, the Johnson tariffs there, which caused the market to have a bit of a meltdown as well for exactly 45 days, the same amount of time we had on this move. That market bounced back and actually went to the 125, had a breather, and then went to the 138 and then all over. So in the past, we can go back and look at quite a few moves when you have that sort of, a bit of a bull run, have that hard reaction, and then you expand to a new high. That sort of 133, 1 to 50, that's kind of where most of them end. So, so this is a bit of concern here that we've got the 138 and the 200, different time frame, different ranges there getting up here. So, and they're big levels in their own right. So all I'm doing is just looking at history. I'm not there's no guarantees of this. I mean, it's all probabilities. Not interest rate cuts, maybe more AI developments can drive the market here. But I just know, from a pure technical maths perspective, those squaring of ranges are just something which has happened in the past over and over again. Just sort of something I monitor, and so we're just hitting those key markers there, which in the past those key markers have stopped. I would say
Any markets?
I'd say probably 80 to 90%. I just noticed not many markets are pushed on. They can, but not as
rare.
Yeah, normally it's a breather there. That's the thing. It's not sort of saying that's going to be the all-time high, because it's sort of, we saw that previous one was going to stop that range, and it just has a reaction there. So we can just get a reaction there and then go later on. But what I did show is that I think majority of those reactions, again, 80, 90% were at least 6 months in duration. So some of them are 6 months, some of them were a couple of years. But at least the majority of them had a 6-month reaction before they went higher again. So, so that's why we got to be a little cautious here, because we're pretty close to some pretty big squarings there.
Right. Well, thank you for explaining that, because I know it took me a while to get. Hopefully for listeners, they've got it. If you needed further explanation, put a comment below. Maybe we'll talk about that later, but we'll work through this more quickly now that we've got that under our belt. The S&P 500, similar sort of thing on the expansions. You've talked about them before. So looking to see that play out.
Yeah. So we saw that. What we're seeing in the NASDAQ right now, we saw this earlier this year into that February high. So we basically went 100% of that range, and then we got a massive reaction. In that case, is a little larger. It was probably, but yeah, pulled back pretty quickly, and it's recovered. It's taken, I think it took 45 days to go down. It took about 90 days to go back up again. Yeah, so. And then in the past, we've had fast moves like that. We've normally got to the 125, had a breather. But oftentimes where we either end around the 138 or potentially 150 if we're really extended there, but not too much on that. So I think that on the S&P there, I think that 6646 is the 138. And then I think something like 6784 would be a 250% extension of that prior range, just another level to keep an eye on there. So you're just watching those levels there. I guess, look, you got to see price action. You got to sort of see sort of signs of maybe distribution taking place, or maybe losing momentum, or maybe running into certain. Either way, there you've got to look at the price action as well as you hit those levels. Just keep an eye on.
Right. Well, the next one that we want to look at, Dow Jones. You've got strong breakout. So it has eclipsed that 100% range that you're talking about. So it has pushed on higher. It did surpass those highs. So we're looking at an old range here. It's broken out, added resistance at 100%, thrown back 100, the full range, and rallied back up. Position that the Dow Jones sits in now is quite different to the NASDAQ and the S&P 500 that you just highlighted, considering the recent highs at the late part of last year, start of 2025. How is it different, and what are you seeing? Still the same sort of outlook for the months ahead?
Yeah, I mean, because probably obviously lagged some of the other indices, but a bit like the XAO, it lagged for a while, and all of a sudden we sped up and caught up. So the Dow Jones there is kind of lagged here, but that sort of 3 attempt to the high and then breaking through, that's quite a bullish setup, Chris. So that's sort of contrary to some of our sort of our S&P and NASDAQ, which are approaching sort of levels there. So that's still fair, positive. But look, that is still a large pullback into the range. So normally you expand a sort of certain amount here, so maybe at least a quarter range of that. So we're still a bit shy of that. So it does look like the Dow maybe can still push on a little higher here, but yeah, I mean, it's the one that looks a little different from everything else. But yeah, I mean, you got the Russell going back to retest the old highs, looking pretty firm here. But you're just going to be a little cautious here. Yeah, I mean, look, maybe you can see maybe growth might start to sort of cool off there. Maybe defensive might come back. So maybe that's supportive of the Dow, and then a NASDAQ might pull a touch. So, it has been pretty much high growth and small caps really here, recently. So they're looking probably the most extended here.
And then if we look at the Aussie, we've got a different type of chart here. We still have the weekly. We've got these ranges once more. And then we're looking at sort of that 133, which is where we've had trouble getting through on our index. And then a different range mapped out over here. We had a resistance at 150, which you talked about before, 161.8. We just got through it, but still having resistance. You've been talking about rotation. We've got a fair few bank charts later in the report to discuss. What's standing out to you here on the Aussie, the index?
Yeah, it's a little messy there. Look, we did get sort of up to that 133 expansion, so that's a fair move there with a pause. So I think in the past there, some of those broad interviews maybe get to a 125 and then had a pause and then kick on. So, I think, we have sort of probably done the normal seasonal pattern. We sort of started to congest and weaken off a little bit when the, in the right sort of window. So again, we're sort of seeing, different variations there. Obviously, the NASDAQ gets some quite bullish. The Dow's probably kind of lagged here, and the XJO's probably followed the normal seasonal pattern here in that, having a reaction to that 125 or 133. So, but it just means we might remain a little choppy here. Still think we got a bit of an advantage there, Chris, and the metals are still pretty hot. So still seeing a sort of strength in gold and, lithium. Uranium's been pretty firm as well. So, the oil stocks have cooled a little bit, but they're still holding up here. So still was pretty bullish. So feels like, we do have, even though we've sort of, inflation has peaked here, we've still got bond yields pretty high. So they're still wary of inflation. And history's told us when you print a bucket load of money from the central bank, so that inflation can linger. So that can be sort of pretty positive for metals. And in the past, they were seeing precious metals and energy be pretty robust in those high inflationary periods. So that might be, some advantage for the Aussie market there. But I think it's going to be a bit choppy here. So, but yeah, I just couldn't see too many great opportunities that we're jumping out here. So just told me just to be a little bit cautious there, and just seeing some big levels, particularly the US, they're sort of made to sort of squarings out just ahead here. So, you got a few big events here coming up here. So, one thing I haven't mentioned there, Chris, and I'm always sort of, half of me gets a bit embarrassed to bring it up here, but those sort of equinox and sort of solstice states, they, when other cycles may not be working, they often work.
It's an odd anomaly. We've talked about it many times, and we start to scratch our heads and look at the tea leaves, but it's amazing what comes from it.
That I remember Bryce, I think it was Bryce Gilmore book there, sort of, I think it's sort of, I don't remember what it was called. There's some sort of, geometry in the markets and stuff there, but he sort of used to talk about that there'd be some, world index would turn every year on the March 22 and September 22, those seasonal dates. And I sort of, when I first read that, I sort of didn't really understand it, but then I just, year after year after year, just seeing indices turn on those dates came across them again. So just sort of something just to keep an eye on here, particularly the way the market's been running here. If that S&P got to say the 138 or 150 or something like that into that window, I'd be pretty wary of that. So, just something to keep an eye on.
Yeah, it's an odd occurrence that happens, but it's also Santa Rally kind of things. It's seasonality. There are changes in our behaviours. I know in Sydney we've got the sunshine, and there's doing a lot of things differently than we were 2 weeks ago when it was pouring down rain and cold. Yeah. It does actually have an impact. But let's go into the individual shares. You've got a few charts here, starting with National Australia Bank. The banks have been talked about a lot. The overvaluation, the extension of Commonwealth Bank. I think at one point it was maybe collectively greater than the 3 other banks together in the market cap. The world's most expensive bank. Many titles that it has held. But we're looking at National Australia Bank right now, and it has still been climbing in this market climate. So can we talk about its success right now and then the trading opportunity?
I was looking at this sort of short term. It just had a nice burst here, and there was some okay volume there, sort of driving it up, and then and we're seeing also that Combat has had a fair reaction off its high. So it's sort of gone from 190, 192 back to 160 odd. So it's had a somewhat pullback there. Whereas, while that's cooled off, all the other three banks have gone straight up. So ANZ, NAB, and Westpac have rounded pretty hard here. So I was just curious how. So I was basically, when I broadened out, had to look at the bigger picture. But wow, that's a a very large broadening pattern there. There's that GFC range, which pretty much is squared out every high in the S&P as a squaring of that range. But oftentimes we've seen here particularly sort of more sort of lower growth markets where you have inflation there, the 70s and the 40s, they were basically, if you look back at those indices there, they are volatile, big up and down moves. And the stocks were the same there. There was, big swings up and down here. So, and we've seen that already. We've seen some massive moves up, false breaks, massive moves down, false break. So marginal new highs, marginal new lows, so really testing these wide ranges there. So, we saw that 2020, you basically go back and make a margin new low of that range. Okay, that gives you a target to go to a marginal new high of the previous range, which we're probably seeing crazy at $15. But we've gone there now, and the stock's on. Yeah, so we're on 19.5 times the yields. We 3.75%, so not particularly great. So yeah, it's fully priced here. So that just tells me there that that's a sort of we've reached our upside target there for that move. This is a point where in the past there in the last few years we've seen a lot of stocks turn at these key levels there. So I'd be very careful about that. That's I remember seeing something like this on the S&P500. 2002, we had a big broadening pattern there. And it called for like a 50% pullback. I just thought, no, there's no way that could happen. And that's GFC, I think it was a GFC, and it came back and retested the low. It was like, so I did sort of, it's funny about that market was I actually stayed out of the way for 3/4 of that. I managed to stay up, but once it was all down 35%, I thought, oh, history is, I think not very often the market's gone beyond 35, 36%. So that was
going to be right by now.
I'd probably start to weigh it in a little bit now. But if I just follow the chart told me that those broadening patterns, they can go to highs and they can broaden out to lows. So so that's telling me to be super cautious here. And to be honest, there, I'm kind of weighing up whether to even look on a short side trade here or something. That's just something for more aggressive traders, but yeah.
Okay, so something more wary, portfolios, selling calls or shorts for more aggressive. Commonwealth Bank, the one that we want to hear more about, in the sense that it has captured so many media headlines. And when you're talking about ranges, went through these sideways channels and then just broke out. So from 100, it almost got to 200, big rally. We all know the story, but I'm interested in your take from the technical side of things of what's happening in the last couple of months to create this weekly chart where it is now.
Yeah, that's when you sort of got to put common sense out the window that sort of big sideways rate. And when every broker would have had, and I think they had valuations in the 90s there, high 90s for this. So no one ever had valuations over $100 in that period. And the things had a massive break. That range ended up being a base, and broken out of that base there and kicked on here. So, but yeah, it's that incredible run. But I guess the last thing on the chart there is that we had a bit of a broadening sort of pattern there. But the pullback has now back and sat on top of that previous. This is probably the first support zone we're sort of seeing for that stock here. So, so I wonder, CBA is kind of gone contrary to the other, when the other three banks have gone up while it's gone down here. Maybe this can rally up here or find some support here while the others come down. But yeah, there's not really a uniform market at the moment. It seems to be there's a bit of disparity between stocks and sectors, and but it really was, I think the last year or two has been sector driven. if you run the right sector, it's all. Well, I think it's all been sector orientated rather than stock orientated. I think if you're in the right sector, you do well. You don't be wrong. There's going to sort of shine there, but I'd say sort of 80-90% of the bigger gains that come by being in the right sector here. So, but yeah, this is the first kick here. I mean, if it was to break below that, that would be a bit of a concern. So, yeah.
All right. Well, next on the list, Life 360, different part of the market in the sense of it's more growth orientated. This share price is nothing short of amazing throughout this part of the year. $15, north of 45, looks to keep going on the weekly chart. So huge movements, great success in the United States. Looking at talking about changing their pricing mechanisms, really good growth there. Technical trading opportunity. How do we address this, Gary?
Yeah, so I just thought, because obviously with a lot of the indices, being near sort of critical, sort of squaring levels, I thought, I wonder what some of the leaders are doing. So I always go and look at sort of some of the leaders. So I think that 360 has been probably one of the strongest stocks on the board here. So I mean, it's gone from 15 to plus 50 here, just over the last 5 months. That's an incredible move. That's in terms of the growth stocks. That's not many that are on that larger sort of scale that have exceeded that level. But when I started squaring the ranges out, I sort of realized that this, that sort of pullback there has now almost, squared out to the 300% of that prior move. So that's sort of a level to keep an eye on. But then I squared out the previous range from that 22 low, which has been a really important low for the stock here. That's kind of quite a fairly decent pullback there. That oftentimes in markets there, you'll often see you'll see like a 3 or 4 year base get built, and then the last drive of the market can be often 50% of the whole move. And you spend sort of 3 or 4 years building this base, and the last 6 months can rally 50% of the move. You see that a lot. It doesn't kind of make sense, but that's the market sort of rolls all the time. We see that last leg up, it can be the most aggressive leg, and the last leg is the market. That usually is a big percentage of the entire range here. So when I started to square this range out there, particularly from that high, so that 24 high there, that sort of if you square that range out from the 22 low to the 24 high, we're now sort of almost squaring that. We're basically sort of that's sort of the the same level around the 300% mark as well. So that's going to be a big massive range as well. So we're squaring that out, and even that pullback back to the April low, that's now going to be that's 3/4 of the entire range. So that's come back, expanded 100%, pulled back 50% of that range, and now expanded 3/4 of that range here. So that's pretty significant as well. So just, and that's all sort of numbers. It won't make sense to a lot of people there. To an old bloke like myself here who's squared ranges out for 20 years and just seen them keep hitting those levels over and over again, find resistance there. I just know that they're important levels to monitor. So like we're seeing resistance there. And we sort of saw, that's had a bit of a gap up into that. So it looks a bit exhausted as well here. So that's a real extent. That's just a massive move. You do not see a 4-year base with a last 4 or 5 months that is 3/4 of the entire range. That's normally like a 50% of the entire range in the last 6 months would be massive. And that you do see that quite often. To see 3/4 of that whole range in the last 4 or 5 months, that's pretty rare. That's a
And then the confluence of these different screen outs that you've just listed, culminating with this number here. That's the rare part. So there are other market commentators who've watched markets for decades, and they've taught me the confluence when you see different indicators pointing to the same price and time.
Well, the only reason I watch 360, Chris, is because I think it's been the strongest. I think it's been one of the strongest stocks on the board. So I'm looking at the leader. So who's the big cap that's had the strongest spine here? I mean, if you look at all the growth investors, all the big cap momentum fund managers, they all have, 360 maybe catapult. There's a few Pro Medicus, there's a few Net Wealth, there's a few of those bigger names in there that they all hold here. So 360 is one that, they're all still pretty bullish on. Yeah. So, but that's just phenomenal move here. That's got me, I mean, like, you breathtaking move. Yeah. It's educational. But that's sort of that should be a little bit of a warning here as well. Just that we've had that range there is, what's been built over the last 4 years. 3/4 of that range has just occurred in the last 4 months. So that's a little scary. So
That is rare.
Yeah.
But well, we'll move to another chart that's less impressive in comparison, but it is tighter range. It is coming off the bottom. Alcoa, AAI being the ticker. April, this is a weekly chart, we should stress. April, May lows, grinding higher, and then working in the channel, but also sort of somewhat congested the last few months, which is positive. What are you taking on Alcoa, AAI?
Yeah, look, there's a little bit of a, you got a VCP of that sort of ascending sort of triangle there. But the whole thing really, just in the last few months, the whole thing's sort of tightening up. So we've basically got a series of higher lows building up there. And then we're congesting under the high as well. So I noticed we did pop through the high yesterday. But yeah, I thought this popped up through the high there wouldn't be bad. I think it's not be worth following here because that's a nice sort of solid base. Built over a reasonable amount of time here. So there is a few heavy volume periods for there as well. So a few volume prints there quite large. So yeah. And we have seen a bit of corporate activity too in this metal space, because even some amongst the bigger names. So yeah, this is definitely a space that's showing strength at the moment.
And then HMC Capital, HMC being the ticker, put that on chart. It does show a massive range. Talking about ranges before, well, it came from sort of that $3.70 mark, $13 mark, back to $3.70 mark. So went up by the stairs, down by the elevator. Flattened out though. Since July, since the start of the financial year, it's sort of traveled sideways.
What's funny, Reed, I'll do those. If it's funny looking at those sort of model books and even looking at the IPO sort of stuff as well, there is a bit of an IPO pattern, sort of like they can have those big moves early and then broaden back out and go back and retest the lows. So we often do see a retest of those old lows on some of those newer name companies. So if you do miss the big move, they often can come back and retest the low and then build again. So this has sort of got me curious there, just because sort of like we have gone to a marginally low, expanded that range, which definitely seen the volume up here over the last few months. So there is signs of accumulation there. And it is in that sort of, the data center space as well. So that's an area there where there's, there's still a lot of excitement there. Maybe a little bit of skepticism about how many coming on board here, but when you look at, the AI, we heard that chat, AI, 10 times the energy required over a Google search there. That's gonna make you nervous about energy, but also, the data centers, is going to
Viability.
going to be a growth area as well. So, got to be careful not to build too many, but definitely feel like this is going to be a, pretty decent area. Just like lithium. Lithium was out of flavor there, 6 months ago, Chris, when lithium prices were suppressed, pretty negative. There was no reason to go near them there. But you thought, maybe at some point, like turn, that you eventually got the turning. So data centers feels like the same to me. We're seeing NextDC had a bit of a pop. That's had a bit of a run. I think Goodman's had a good run there, but there's a few other names still lagging yet. But probably a little bit of a hangover from some of those prior rallies, but definitely a sector to be keeping an eye on there. So HMC, I think Digico, which do have a connection now, I think. HMC do hold some Digico.
Well, with that Digico chart, you've got that on screen for us. How are you reading that? Similar thing, similar overarching, but technically, what's different?
The one thing I sort of was watching that, and it is a newer name, so I haven't been around very long, but the price action there, we can sort of see the whole thing sort of tightening up here. I think sort of since then, we've tightened up even more. So we're still sort of in a tight sort of sideways congestion there. What you want to sort of see is eventually you'll see a sign of strength and you'll come out and break a swing high in that move there. And that's what those sort of volatility contraction patterns there you want to sort of see. I mean, you'd like to see the stock above the 50-day moving average. That's sort of one thing there. So kind of want to sort of see it flatten out a little bit. But breaking above that sort of swing high there, maybe a bit of volume coming in as well. But this is one that I'm just watching pretty closely just because we're seeing that sort of contraction in price. It is one of the sectors which potentially could have a larger recovery there longer term.
Well, that's some good insights in a market that is questionable, with the indices looming so close to the confluence for those squaring ranges. And we've got some insights as to what we can be looking at for that next opportunity if it does rotate through. And we say thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.
If you want to learn more about those leaders like 360, Gary's drilled down into them. It's really the nth degree of detail to look at the setups. Click on the model book on the right-hand side so you can learn more about those market leaders and become a better trader.